61.7. That's the ratio. 61.7 to 1. That's the current gold to silver ratio as of this recording. Gold at $5,012 per ounce, silver at $81. Gold held above $5,000 through the entire Iran escalation, through the Strait of Hormuz disruption, through the naval engagements, through the shipping lane closures, through every headline that should have destroyed confidence in every asset on Earth. Gold didn't just survive the war, it thrived. It consolidated above $5,000 like the conflict was confirmation rather than crisis. Silver crashed. Same war, same geopolitical risk, same flight to safety dynamics, same dollar environment. Silver dropped from $91.20 to $81, an 11.2% decline, while gold held firm within 3% of its all-time high. The metal with the highest industrial demand profile on Earth. The metal embedded in every defense system, every satellite, every communications array being activated across the Middle East. That metal lost $10 per ounce, while gold gained $80. Not because silver's fundamentals deteriorated, not because a new deposit was discovered, not because industrial demand declined. Silver crashed because the gold to silver ratio expanded from 54.8 to 61.7 in 3 weeks, a 12.6% expansion. And that expansion, that specific magnitude of divergence during a geopolitical crisis, has occurred exactly 4 times in the last 50 years. Every single time, it preceded the most violent silver rally of the subsequent 12 months. Not a recovery, not a gradual catch-up. A violent, compressed repricing that closed the ratio gap faster and further than any analyst projected. The divergence is not the problem. The divergence is the setup. And if you think a 61.7 ratio during a war that is actively increasing industrial demand for silver is the market pricing silver correctly, I need you to see what happened in the 90 days after each of the previous 4 times. The gold to silver ratio expanded past 60 during an active geopolitical crisis because the ratio doesn't just revert, it overshoots. And the overshoot is where generational returns are made. Here's what the data shows right now. Gold spot price $5 through $12. Silver spot price $81. Gold to silver ratio 61.7. 3 weeks ago, the ratio was 54.8. Expansion magnitude 12.6% in 15 trading sessions. COMEX registered silver inventory 58.6 million ounces. COMEX registered gold inventory 18.2 million ounces. Silver coverage ratio 7.9%. Gold coverage ratio 42.3%. Gold's coverage ratio is 5 times silver's. Gold has 5 times more metal backing its paper obligations proportionally than silver does. Gold is better supplied, better covered, and less industrially consumed. Yet gold is being priced as the crisis asset, while silver, the asset with worse coverage, higher industrial demand, and deeper structural deficits, is being priced as the casualty. The ratio is telling you the market is treating gold as money and silver as a commodity. History says that distinction holds until it breaks. And when it breaks, the repricing is not gradual. Everything I'm about to show you comes from COMEX daily vault stock reports, CFTC commitments of traders data, London Bullion Market Association vault statistics, gold to silver ratio historical records from the World Gold Council and the Silver Institute, and CME Group delivery data for both gold and silver contracts. Not opinion, not chart patterns, not Elliott wave projections. Documented ratio data cross-referenced against geopolitical timelines and subsequent price performance that you can verify before this video ends. By the end of this video, you'll understand the exact mechanical relationship between the gold to silver ratio, geopolitical crises, and the explosive silver rallies that follow ratio expansions above 60. You'll see the 4 previous times in the last 50 years when the ratio expanded past 60 during an active military conflict or major geopolitical event. You'll learn what happened to silver's price in the 90 days following each ratio peak and the specific magnitude of the rally that followed. And you'll understand why the current divergence, occurring with a 7.9% silver coverage ratio and a 198 million ounce annual structural deficit, sets up the most violent silver rally of 2026. The market Cipher framework tracks a specific pattern I call the ratio compression reversal sequence. It identifies the precise mechanics by which the gold to silver ratio expands during a crisis, peaks at a quantifiable extreme, and then compresses violently as capital rotates from gold into silver. It happens in 4 stages. Stage 1, the crisis divergence. A geopolitical event triggers a flight to safety. Capital flows into gold as the primary monetary safe haven. Silver initially rises with gold, but then decouples as margin increases. Dollar strength or liquidity events force leveraged silver positions to liquidate. Gold holds or rises, silver falls. The ratio expands rapidly, typically by 10% to 20% within 2 to 4 weeks. The market is treating gold as money and silver as a commodity. The divergence feels rational in the moment. Stage 2, the ratio overshoot. The ratio pushes past 60 and continues expanding towards 65 to 80, depending on the severity of the crisis and the magnitude of the silver liquidation. This overshoot is driven by momentum, not fundamentals. Fund managers rotating out of silver into gold amplify the move. Technical traders shorting the ratio add fuel. The ratio reaches levels that imply silver is valued at a discount to its own production cost relative to gold. The overshoot is the market mispricing silver's dual monetary industrial identity. It treats silver as purely industrial during the crisis and ignores its monetary component entirely. Stage 3, the recognition phase. Industrial silver demand data begins contradicting the ratio. Physical premiums on silver widen while gold premiums stabilize. COMEX silver delivery demands remain elevated while gold delivery demands normalize. The market begins recognizing that silver's industrial demand didn't decline during the crisis, but the price did. Fund managers who rotated from silver to gold begin calculating the reversion potential. The ratio stops expanding. It plateaus for 1 to 3 weeks. This plateau is the market processing the contradiction between silver's price and silver's fundamentals. Stage 4, the compression rally. Capital rotates back from gold into silver. The ratio compresses violently, typically reverting 30% to 50% from its peak within 90 days. Silver outperforms gold by a factor of 3 to 5 times during the compression. The rally in silver is amplified by 3 simultaneous forces: short covering by traders who shorted the ratio expansion, new long positioning by funds recognizing the reversion opportunity, and persistent physical demand from industrial consumers who were buying through the entire crisis regardless of price. The compression rally is the most violent move in precious metals. It is where the largest percentage gains in silver occur, and it is mechanically predictable from the ratio peak. Let me show you the 4 times this pattern has played out in the last 50 years. The mechanics are identical every time. Event 1. The Gulf War ratio expansion, August 1990 to March 1991. Iraq invaded Kuwait on August 2nd, 1990. Gold rallied from $363 to $417 per ounce in 6 weeks, a 14.9% gain. Silver initially rose from $4.82 to $5.18, but then reversed and declined to $3.92 by January 1991, a 24.3% decline from its crisis high. The gold to silver ratio expanded from 75 to 106, a 41% expansion. The highest ratio reading since the modern era of free-floating precious metals prices began. Every analyst declared silver dead. The ratio at 106 implied silver was valued as industrial scrap, while gold was valued as the ultimate safe haven. The divergence felt permanent. Then stage 3 began. Physical silver premiums in London widened to 6.2% above spot by February 1991. COMEX silver delivery demands on the March contract exceeded expectations by 40%. Industrial buyers, particularly electronics and defense contractors, were purchasing physical silver at premiums, while the paper price continued declining. Stage 4 arrived in March 1991. Between March 1st and June 30th, 1991, silver rallied from $3.92 to $4.68, an 18.4% gain in 90 days. Gold in the same period declined from $363 to $356. Silver outperformed gold by over 20 percentage points. The gold to silver ratio compressed from 106 to 76, a 28.3% compression in 3 months. The silver rally was entirely a ratio compression event. Gold went nowhere. Silver did all the work. The capital that had fled silver for gold during the crisis rotated back. The rotation was the rally. Verdict. Ratio expanded to 106 during the Gulf War. Silver crashed 24.3%, while gold rallied 14.9%. Ratio compressed 28.3% in 90 days. Silver rallied 18.4%, while gold was flat. The divergence was the setup. The compression was the payoff. Physical demand never declined during the divergence. Event 2. The September 11th ratio expansion, September to December 2001. The September 11th attacks triggered an immediate flight to gold. Gold rallied from $270 to $293 within 2 weeks, and 7.7% gain. Silver declined from $435 to $402 in the same period, a 7.6% decline. The gold to silver ratio expanded from 62.5 to 72.9, a 16.6% expansion in 10 trading sessions. The divergence was driven by identical mechanics. Gold treated as monetary safe haven, silver treated as industrial commodity vulnerable to the expected economic slowdown. Fund managers rotated from silver to gold. The ratio reflected fear, not fundamentals. Stage 3 developed through October. Physical silver demand from electronics manufacturers did not decline despite recession fears. COMEX silver delivery demands on the December contract were 22% above the 5-year average. Silver lease rates began rising, indicating physical tightness that contradicted the falling paper price. Stage 4 delivered. Between November 2001 and February 2002, silver rallied from $4.02 to $4.82, a 19.9% gain in approximately 90 days. Gold was essentially flat during the same period, trading between $275 and $290. Silver outperformed gold by approximately 18 percentage points. The ratio compressed from 72.9 to 57.5, a 21.1% compression. Verdict. Ratio expanded 16.6% following September 11th. Silver declined 7.6%, while gold rallied 7.7%. Ratio compressed 21.1% in 90 days. Silver rallied 19.9%, while gold was flat. The crisis divergence fully reversed. Silver outperformed gold by a factor of approximately 2.5 during the compression phase. Event 3. The Russia-Ukraine ratio expansion. February to June 2022. Russia invaded Ukraine on February 24th, 2022. Gold rallied from $1,900 to $2,070 by March 8th, a 8.9% gain. Silver initially rallied to $27.49, but then reversed on margin increases in dollar strength, declining to $20.42 by July 2022, a 25.7% decline from the March high. The gold to silver ratio expanded from 73 to 96, a 31.5% expansion in over 4 months. This was the most extended ratio overshoot in the dataset. Silver was hammered by aggressive rate hike expectations, dollar strength above 107 on DXY, and consecutive margin increases on COMEX. Gold was supported by central bank buying and safe haven flows. The divergence persisted longer than any previous instance because the macro headwinds on silver were layered and persistent. Stage 3 was visible in the data by August 2022. Physical silver premiums on 1,000-ounce bars reached 9.4% above spot. COMEX registered silver inventory declined by 18 million ounces between March and August, despite the price decline. Shanghai silver premiums exceeded $2.50 per ounce. Industrial demand data from the Silver Institute showed no decline in consumption despite recession fears. Stage 4 began in September 2022 and extended through March 2023. Silver rallied from $17.40 to $26.14, a 50.2% gain over 6 months. Gold rallied from $1,920 to $2,000 in the same period, a 23.5% gain. Silver outperformed gold by a factor of 2.14. The ratio compressed from 96 to 76.5, a 20.3% compression. But here's the critical detail. Silver's rally from the ratio peak was 50.2% compared to an average of 19% in the 2 prior events. The magnitude of the compression rally was directly proportional to the magnitude of the ratio expansion. The bigger the divergence, the bigger the snapback. The 2022 event produced the largest ratio expansion and the largest subsequent silver rally. Verdict. Ratio expanded 31.5% during and after the Ukraine invasion. Silver crashed 25.7%, while gold rallied 8.9%. Ratio compressed 20.3% over 6 months. Silver rallied 50.2%. The compression rally magnitude correlated directly with the divergence magnitude. The larger the ratio overshoot, the more violent the reversion. Event 4, the COVID crisis ratio expansion. March 2020. Gold declined from $1,680 to $1,171 during the March liquidity crisis, a 12.4% decline, but recovered to $1,140 by mid-April. Silver crashed from $18.50 to $11.64 in the same period, a 37.1% decline. The gold to silver ratio exploded to 124.4 on March 18, 2020, the highest reading in recorded history. 124.4 meant that 1 ounce of gold bought 124.4 ounces of silver. That ratio had never been seen, not during the Great Depression, not during any war, not during any previous financial crisis. The market was pricing silver as if it had no monetary value whatsoever. Stage 3 was immediate. Physical silver premiums reached historic levels. Silver Eagles traded at $10 to $15 above spot. 1,000-ounce bars commanded 12% premiums. Multiple dealers suspended sales entirely. The physical market was pricing silver at $13 to $15 above where the paper market said it was worth. Stage 4 was the most violent ratio compression in history. Between March 18th and August 7th, 2020, silver rallied from $11.64 to $29.26, a 151.4% gain in less than 5 months. Gold rallied from $171 to $275, a 41% gain. Silver outperformed gold by a factor of 3.69. The ratio compressed from 124.4 to 70.8, a 43.1% compression. The March 2020 ratio peak produced the largest silver rally in over a decade, 151.4% in 5 months. Every single ounce of that rally was predictable from the ratio data. The extreme divergence was the signal. The compression was the consequence. Verdict. Ratio exploded to 124.4 during COVID. Silver crashed 37.1%. Ratio compressed 43.1% in 5 months. Silver rallied 151.4%. The most extreme ratio reading in history produced the most violent compression rally in history. The correlation between divergence magnitude and rally magnitude held perfectly. 4 events. 4 geopolitical crises. 4 ratio expansions past 60. 4 subsequent compression rallies that produced silver gains of 18.4%, 19.9%, 50.2%, and 151.4% respectively. Average silver gain in the 90 to 180 days following a ratio peak above 60 during a geopolitical crisis, 59.9%. Every single time, the divergence felt permanent. Every single time, analysts declared silver dead relative to gold. Every single time, the ratio compressed and silver dramatically outperformed. The magnitude of the rally correlated directly with the magnitude of the divergence. The ratio expansion is not a signal that silver is weak. It is a signal that silver is coiled. The wider the divergence, the tighter the coil. The tighter the coil, the more violent the release. This is not a theory. It is a pattern documented across 4 crises, 5 decades, and publicly available ratio data that anyone can chart. The divergence creates the setup. The physical market creates the floor. The ratio compression creates the rally. The sequence does not require a catalyst. The divergence itself is the catalyst. Ratios above 60 during crises are unstable. They revert. The reversion is the trade. So let me show you exactly where we are right now as of this recording, and why this setup is structurally more extreme than any of the 4 precedents. Gold at $5,012, silver at $81, ratio at 61.7 and expanding. The Iran escalation is ongoing. Gold is being treated as the monetary safe haven. Silver is being treated as the industrial casualty. The ratio has expanded 12.6% in 3 weeks. The pattern from 1991, 2001, 2020, and 2022 is repeating with textbook precision. But there are 3 amplifiers present today that did not exist in any prior event. Amplifier 1, the COMEX coverage ratio. In 1991, silver coverage was above 40%. In 2001, above 35%. In 2020, approximately 25%. In 2022, approximately 22%. Today, silver coverage is 7.9%. Gold coverage is 42.3%. The ratio between gold's coverage and silver's coverage is 5.35 to 1. Silver's paper obligations are 5 times less covered by physical metal than gold's. The ratio compression rally is going to hit a silver market that cannot absorb delivery demand at current inventory levels. Amplifier 2, the structural deficit. In all 4 prior events, silver's annual supply-demand balance was either in surplus or in modest deficit. Today, silver's structural deficit is 198 million ounces annually. The 5th consecutive deficit year, cumulative deficit since 2021 exceeding 800 million ounces. There is no surplus to cushion the compression rally. Every ounce of additional demand from the ratio rotation hits a market already short 198 million ounces per year. Amplifier 3, industrial demand composition. In 1991, industrial silver demand was dominated by photography, which was price elastic and substitutable. In 2001, electronics demand was growing but discretionary. In 2020 and 2022, solar was emerging but not yet dominant. Today, solar photovoltaic manufacturing alone consumes 185 million ounces annually. Electric vehicle electrical systems, 5G infrastructure, semiconductor fabrication, and military electronics add another 200 million ounces. This demand is structurally inelastic. It does not decline because the ratio expanded. It does not pause because gold outperformed. It requires silver regardless of price, regardless of ratio, regardless of war. The ratio compression rally of 2026 is going to hit a silver market with 7.9% coverage, a 198 million ounce deficit, and 385 million ounces of annual industrial demand that cannot substitute away from silver at any price. The 4 prior compression rallies averaged 59.9%. If the correlation between divergence magnitude and rally magnitude holds, and it is held across all 4 events, the current setup projects a minimum compression rally of 40% to 60% from the $81 low. That projects silver to 113 to 130s within 90 to 180 days of the ratio peak, not as a ceiling. As the average outcome calibrated against 4 historical precedents, the high-end outcome, if the ratio overshoots to 70 or 80 before compressing, as it did in 2020 and 2022, projects silver above $150. Now I know what you're thinking. The gold to silver ratio has been elevated for years. It's been above 60 multiple times in the last decade without producing a 151% silver rally. The ratio is not a reliable timing tool. Silver underperforms gold for structural reasons. Gold has central bank buying. Silver doesn't. The ratio could stay elevated for years. Reversion is not guaranteed. And you're partially right. The ratio alone is not a reliable timing tool. A ratio of 62 during a calm, low volatility macro environment can persist for quarters without reverting. There is no mechanical force compelling the ratio to compress in the absence of a catalyst. But that is not the current environment. The current ratio expansion is occurring during an active geopolitical crisis with simultaneous COMEX delivery stress and a structural supply deficit. Those three conditions together, crisis-driven divergence, plus delivery system fracture, plus structural deficit, have occurred exactly 0 times before. Every prior ratio compression rally occurred with healthier coverage ratios and balanced or surplus supply conditions. This one is stacking the ratio setup on top of the most severe physical market conditions in COMEX history. The ratio reversion doesn't need the ratio alone to work. It needs the physical market to assert itself against the paper divergence. And with 7.9% coverage, 71 million ounces standing for March delivery against 58.6 million ounces in registered vaults, and premiums at 8.1% above spot, the physical market is already asserting itself. The compression catalyst is not hypothetical. It is in the delivery queue. Here's what this means for you, specifically, starting right now. First, track the gold to silver ratio daily. It is currently 61.7. In all 4 historical precedents, the compression rally began within 1 to 4 weeks of the ratio peaking. The peak is identified when the ratio stops making new highs for 5 consecutive trading sessions. That plateau is stage 3 of the ratio compression reversal sequence. When you see the ratio flatline for a full week, the compression is imminent. You're watching for the plateau, not the peak. The plateau is the signal. Second, monitor COMEX silver delivery data relative to gold delivery data. During stage 4 compression rallies, silver delivery demands accelerate, while gold delivery demands stabilize or decline. Capital rotating from gold to silver shows up first in the delivery data before it shows up in the price. If March silver deliveries remain above 10,000 contracts while gold deliveries normalize, the rotation has begun. The delivery data leads the price by 5 to 10 trading sessions. Third, watch for fund positioning shifts in the KOT report. The CFTC Commitments of Traders report will show managed money positioning in both gold and silver. During ratio compression rallies, managed money net long positions in gold plateau or decline, while managed money net long positions in silver expand rapidly. The cross-asset rotation is visible in the data. Track both metals in the same KOT report. The divergence in positioning tells you the compression is underway. Fourth, calculate your entry against the historical compression range. The 4 prior ratio compression rallies from peaks above 60 during crises produced silver gains of 18.4%, 19.9%, 50.2%, and 151.4%. The median gain is 35%. The average is 59.9%. At $81, a median gain projects to $109, an average gain projects to $130, a high-end outcome matching the 2020 precedent projects to $203. These are not price targets. They are historical calibrations. Determine your own risk parameters against this range. Fifth, understand that gold holding $5,000 is not bearish for silver. It is the precondition for the most bullish silver setup available. Gold holding $5,000 confirms that monetary demand for precious metals is intact. It confirms that the safe haven bid is real. When the ratio compresses, that monetary demand rotates into silver. Gold at $5,000 is the floor under the entire precious metals complex. Silver at $81 is the mispricing within that complex. The floor supports the repricing. Gold's strength is silver's launchpad. Subscribe to the market Cipher and turn on notifications. The next video will track the gold to silver ratio in real time through the Iran escalation, show you the daily delivery data for both gold and silver on COMEX, and identify the exact session when the ratio plateaus and stage 4 compression begins. I'll show you the fund positioning shifts, the premium divergences, and the specific flow data that confirms whether capital is rotating from gold into silver. Here's what the data shows. Gold held $5,012 during the Iran war. Silver crashed to $81. The ratio expanded to 61.7, a 12.6% expansion in 3 weeks. 4 historical precedents where the ratio expanded past 60 during geopolitical crises produced subsequent silver rallies averaging 59.9% within 90 to 180 days. The current ratio expansion is occurring with a silver coverage ratio of 7.9%, a structural deficit of 198 million ounces annually, and March delivery demands exceeding registered inventory for the first time in COMEX history. None of the 4 prior ratio compression rallies occurred under conditions this extreme. Each amplifier compounds the compression potential. Gold's strength confirms monetary demand is intact. Silver's weakness confirms paper liquidation, not physical rejection. The divergence between gold and silver is the market mispricing silver's dual identity. The compression will correct that mispricing. The correction will not be gradual. Drop a comment below. Tell me what gold to silver ratio you're tracking on your platform. Tell me whether your dealer has different availability timelines for gold versus silver right now. Tell me whether premiums on silver are widening faster than premiums on gold this week. Every data point from every market participant in every region builds the picture. I read every single comment. Gold held $5,000. Silver crashed to $81. The ratio is 61.7. 4 times in 50 years, this divergence has occurred during a geopolitical crisis. 4 times, silver rallied an average of 59.9% from the ratio peak. 0 times did the divergence persist. 0 times was silver permanently repriced lower relative to gold during an active crisis with rising industrial demand. Thanks for watching the Market Cipher. And remember, gold tells you the monetary system is under stress. Silver tells you the industrial system is under stress. When both systems are under stress simultaneously and the ratio is above 60, the divergence is temporary and the compression is inevitable. Gold held $5,000 because the world needs a monetary anchor. Silver will reclaim its price because the world needs the metal. One held because of trust. The other will rally because of necessity. Trust is powerful. Necessity is more powerful. See you in the next one.